Welcome back to the Plan Future Insight. What a wonderful question. This is exactly where every great wealth journey begins. Understanding where you stand today before planning where you want to go tomorrow. As your Dada, I am genuinely proud you are asking this. Let us build this step by step, simply and clearly. First, we start with a simple truth. You need a full body checkup for your money. Think of it as your wealth MRI. We measure 7 vital signs. Let us start with your net worth. This is your financial snapshot. It is simply what you own, minus what you owe. For example, if your assets like your house, car, and investments total 1.16 crore rupees, and your liabilities like loans total 54 lakh rupees, your net worth is 62 lakh rupees. A positive and growing net worth means you are building wealth. Track this every 6 months. Second, your emergency fund. This is your financial shock absorber. You need 6 to 12 months of essential expenses set aside. If your monthly essentials are 50,000 rupees, you need 3 to 6 lakhs in a liquid fund or savings account. Without this, any market dip can force you to sell investments at a loss. Build this before aggressive investing. Third, check your liquidity ratio. Are 10 to 15% of your assets in cash or liquid funds? Or are you over-invested in long lock-in instruments? Balance is key. Fourth, your debt-to-income ratio. Take your total monthly EMI and divide it by your monthly take-home salary. The safe zone is below 30%. If you are above 50%, you need immediate debt reduction. Fifth, your savings rate. This is your wealth engine. Take your monthly savings divided by your monthly income. A good rate is 20%. An excellent rate is 30% or more. My golden rule is to pay yourself first. Automate your SIPs the day your salary arrives. Sixth, insurance coverage. This is your financial safety net. You should have term life insurance worth 10 to 15 times your annual income. You should have health insurance of at least 10 lakh rupees for your family. Many Indians are severely underinsured. Seventh, your investment asset allocation. This is your growth mix. A simple rule is 100 minus your age for equity exposure. So, at age 30, around 70% equity and 30% debt. Check your current mix. Are you 100% in equity or fixed deposits? Rebalance. Now, here is where it gets interesting. You must map your finances to your life goals. This is where most people miss the bus. For a child's education needing 25 lakhs in 13 years, consider equity mutual funds. For a 5 crore rupee retirement in 30 years, consider a mix of PPF, NPS, and equity funds. For a 6 lakh rupee vacation in 3 years, a hybrid fund may be suitable. And your emergency fund needs to be immediate and in a liquid fund. The bottom line is, analysis without action is just entertainment. Your financial status is a living, breathing entity that grows with discipline. The biggest wealth destroyer is inaction. Here is what you can do this week. First, calculate your net worth. Use a simple sheet. Be brutally honest. Second, within 1 month, build your emergency fund to cover 6 months of expenses. Third, within 3 months, get term insurance and health cover if needed. Then, start one SIP in a regular flexi cap fund for your longest term goal. Revisit this analysis every 6 months. Dada's wisdom of the day. A journey of 1,000 miles begins with a single step, but also with a clear map. You have just picked up the map. Now let us walk together. I am genuinely proud of you for asking this question. Most people never do. Remember, investment in the equity market is subject to market risk. We do not claim any guarantee of return in equity-related investments. Past performance is not indicative of future results. For personalized guidance, connect with a registered financial professional. Let us build your legacy, one disciplined step at a time. Investment Dada Wisdom Session. Analysis without action is just entertainment. Your financial status is not static, it's a living, breathing entity that grows with discipline. The biggest wealth destroyer is inaction. Start with one step. Calculate your net worth today. Why regular mutual funds via a trusted MFD? Because when markets crash 30%, like 2008, 2020, 90% of direct investors panic and exit at the bottom. Your MFD is your financial bodyguard. They ensure you stay the course and actually complete your 20-year wealth journey. That behavioral guidance is worth every rupee of the small commission. Dada's action plan, start today. Step 1 this week. Calculate your net worth, assets, liabilities. Use a simple Excel sheet. Be brutally honest. Step 2 within 1 month, build your emergency fund to 6 months of expenses. Open a liquid fund, regular, SEEP if short. Step 3 within 3 months, get term insurance, if uninsured, and health cover. Then, start one SEEP in a regular flexi cap fund, like those in the live data, for your longest term goal. Step 4 every 6 months, revisit this analysis. Rebalance if allocation drifts greater than 5%. Dada provides educational wisdom and guidance. Always consult your registered financial professional before implementation. Investment in equity market is subject to market risk. We do not claim any guarantee of return in equity-related investments. Thanks and regards, Kaustav Bishwas, www.planfuture.in